In this week's update, perfect environment for precious metals miners to start sizzling, and the best way to beat these market conditions if you've had a bad week. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. So I guess everyone has had a pretty tough week. So a really important topic this week is how can we navigate weeks like we've just had, months like we've just had, in a calmer, less stressed fashion. I think that probably should be of interest to everybody. So if your objectives are to reduce short-term drawdowns and all the stress that goes with it, then there's some things that you can do. You don't have to be a victim of it. You don't have to continue to operate in this sort of environment. You can do something different because we control most of the factors that influence our long-term results. Secondly, if you want to be able to still get on board the new unfolding trends and to be able to amplify the profits so that you can continue to look forward to results that are far in excess of what the index delivers. And the Australian index has been pretty disappointing over the last couple of years relative to other opportunities around the world. So the answer is to work with volatility, not fight against it, which is our natural process, our natural inclination. And there are things that we can definitely do, and they're around just stacking the odds in our favour. And there are many things that we can do, in fact, many more things that we can do to stack the odds in our favour than the other way around. And we can do this either with ETFs or individual stocks. It doesn't matter. So we just need a couple of simple filters. Filter number one is to put ourselves in the right fishing hole. So we want to consider quality, value, and the probability of the future unfolding well as we expect it to. So that's all the fundamentals. And then also look at the future reward for risk as well. So that's filter number one, gets us in the right fishing hole. Filter number two is then technicals. It's overbought, oversold. So we're looking for extremes. And then we're just using the money flows to help us confirm the turning points. So we're looking to reduce our exposure when stocks or sectors get significantly overbought and have a keen eye to getting back into those sectors when they get to oversold, as they all do. All sectors and all stocks cycle between being oversold and overbought. So why not just use those extremes to advantage? Really important in this sort of environment more than anything else you've probably experienced in your investing lifetime, because I don't think this volatility is going to go away anytime soon. So you just need to make sure that you're organised. You've got a plan, you've got all the advice that you need, and you get some patience and confidence in the long term of what you're investing in. So American stocks, S&P was up 0.65 for the week, the NASDAQ very similar, but the Russell was up 4%, did really well, and that's a very good sign that small caps could do well in such a massively volatile environment. But it certainly was a week of just exhausting volatility because it was irrational. It was significantly down one day and then immediately reversed the next day. It's very hard emotionally to deal with that. And there's certainly been a lot of suggestions in the press that markets or announcement timings, let's put it this way, if announcement timings for the White House certainly have a view to the midterm elections. The last thing that Trump would need would be a stock market that's in trouble leading into the midterm elections. So is there some kind of Trump put on the cards? Is it already underway? Some curious timings have been happening over the last few months with respect to the war in the Middle East and the market. Now, we saw on the end of the week, very nice commodity turn from grossly oversold, which is what you expect. Things just don't keep rising to the moon and they don't keep falling through the floor. So eventually we get to points where markets will reverse. But it's hard to see a really significant correction because the growth relative to the PE ratios for so many tech stocks, hundreds of tech stocks, is still really quite attractive. So I think the American market, certainly for one, not so much necessarily the Australian market, but the American market is still a buy the dip environment. If you've got good fundamental stocks and sectors, then this is an environment where buying oversold offers considerable advantages. The US dollar finished just under the 100 mark. The yield 4.5 and the VIX index was at 17.7. Let's go and look at some charts. We'll start with the NASDAQ composite, and this is on a daily chart. So this was last Friday. This was the big decline that we saw that surprised, I guess, a lot of people in terms of its extent. But it was caused a lot by the semiconductor index, SMH. So this was the semiconductors finally giving back some profit from this amazing run where it had run from the end of the ETF from 376 to 644. So some 85, 90%. And then we had an abrupt pullback. But then after that, the market said, no, we're not going there. We're going to solidify. And the market certainly finished, or the SMH finished in positive fashion into the end of the week. Now, if we look at on a sector money flows basis, technology is still absolutely shooting the lights out. And it's the only one that's above the S&P, not only for the year, but is trending up. In the Australian market, it's far less clear, far less enticing. We've got materials has floated to the top of the heap. But look, to be honest, none of them are doing sensationally well. Technology in Australia had a run for a couple of weeks, but certainly pulled back last week. And then we've got the ASX 200 and everything else, including finance. And of course, healthcare is below that. The S&P, similar to the NASDAQ on a weekly basis, and there's the Russell. So turning now to the Australian market, the Aussie dollar was at 69.8, just below the 70-cent mark. Our index put on 2.1% for the week, and you would think would be positive next week. It was a short week, obviously, with the holiday, but it was just wildly volatile. It left a lot of people a bit stunned, and we saw certainly some volatile rotations. Now, turning to precious metals, gold was down 2.5% for the week, so down to 42.22. So it continues to fall, defying the long-term fundamentals that are real. I don't think there's any question about that. We're just going through a period, as you'll see on the chart, where the market had moved too far too fast, and we're getting a bit of a pullback in conjunction with the fact that we've got uncertain signals from the White House. Middle East war equals higher oil, equals higher yields, equals lower gold. It doesn't necessarily add up, but it's how the market's perceiving it. In Aussie dollars, 6,000. So we're down about $1,500 from the peak in Australian dollars. Silver was at 68, so we've seen support levels, likely support levels for both gold and silver break. For gold, the next support level is around 4,000, give or take $100 above and below. I've been looking at the ratio between the gold price and the S&P price as the trigger. My argument being that the gold price will not turn around and move up until this war is finished and the market stops focusing on yield. And so we need to see gold start to outperform the S&P index, and it hasn't happened yet, but it certainly is into oversold, grossly oversold territory. And then, not an absolute guarantee, but with a high degree of probability, miners then follow. So we're in a territory now of gross oversold where a turn up certainly has some pretty high probability attached to it. If we look at gold stocks, then you step back and you put aside the smashing that you've had in the last few months, and particularly the last week, where it's very difficult to see the wood for the trees. But if you look at it completely calmly and rationally, this is a perfect environment for gold miners to start to perform. Now, they may not start to perform for a couple of weeks, couple of months, or it might have started on Friday night. I have no idea. I don't really care, because the market will be my guide. But there are always very big advances and declines in gold stock bull markets. That's just a fact of history. Go back and look at any other bull market in precious metals, and you'll see substantial advances and declines that shake your teeth, but that's just how it works. Sentiment couldn't be much worse. Public opinion has deserted the ship. People are throwing their hands in the air and saying, that's it, oh, it's just too hard for me. I'm out of here. But that's just the time, because the sellers are getting purged out of the market. We'll get to a point where the smarter buyers will step back in and overwhelm the not too many sellers that are left. So public opinion has deserted the ship. Perfect for a contrarian trade. We've got ratios in a number of areas at extremes. Fundamentally, we've got producers that are cheap. They're producing truckloads of free cash flow, and we're into an acquisition phase for development stocks. It just couldn't get a whole lot better. And have we just seen some sort of capitulation when you look at the chart in gold miners? So let's go and take a look. And we'll start with gold. So there's the gold price in US dollars we wanted. So we started a bull market in 2024, at least on a weekly time frame. Then we had a massive advance, and now we've had a 29% fall over 4.5 months or thereabouts. This is stock standard bull market behavior. I know last week was hard, really tested the emotions and the psychology, but this is stock standard stuff. It's just a bit more savage, a bit more volatile than normal. The silver price on a daily chart is also broken down through the 200-day moving average. So there's certainly been some technical damage done. However, this is the gold versus S&P, and we've been in strong decline since March, since the war started, and we haven't turned yet. But this will turn, and gold stocks will start to outperform. So this is the key trigger. So you need to start getting prepared for what you're going to buy, because there will be a good period for gold miners coming, and it is likely that it's going to be multiple years, and that we could advance in gold stocks for the next 5 to 10 years, but albeit with this kind of decline. So we've had a very substantial decline, as you can see. But Friday certainly, or last week, this is on a weekly chart, so last week we had a gap down, very significant gap down after the thrashing that commodity stocks had the previous Friday in America. And I think where we're sitting at the moment, with all of the fundamental factors, with all of the contrarian opportunities that it presents, you could do worse than start to get prepared to accumulate down at these levels, these oversold levels. Understand what it is that you want to buy and wait for confirmations. So back to the other commodities. Copper finished at 625. Crude oil around about 85 was the finish, so it's down quite a bit. But look, this is a market that's just being overrun by rhetoric out of the White House and the Middle East. So it's incredibly unpredictable. We've got record output, so that's oil production coming out of everywhere else but the Middle East. Now, that's not strictly true, but that'll do for a general statement. There is certainly increased production coming out of the Americas. That's unpredictable. Obviously, what happens in the Straits of Hormuz is unpredictable. We've got just so many more factors that are just transient. They're not normal. So I find it an incredibly difficult market to form an opinion that this is a high probability trade. Here's the Bitcoin chart, just hanging on to support at 60,000. There's a copper chart in certainly medium and longer term uptrend. Crude oil looking more like it's going to break down than break up. But again, that's just so hard to know. So the final message here, and particularly focusing on miners and commodity stocks, which I think are going to be more than any other sector, commodities offer really significant advantages by waiting to buy the deep corrections, because commodities tend to be more volatile. So wait a bit longer for deeper corrections. And we've moved to that point now. We just need the confirmation of a turn. The level that we're at now means, by definition, there is less downside and far more upside. And that means far less stress and uncertainty like last week provided. So if you have to wait 6 to 12 months, my view of that is, so what? Is it worth having a simple plan and a bit of extra patience to make a big impact on your wealth, huge impact on your wealth? Now, that can be good impact if you do it well, but I'll promise you it'll be a bad impact if you don't do it well, with a proper plan and some patience and some discipline. That's just the kind of market we're in. So that's it for this week. Short and sweet. More information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.